Mr. Aurora and team, if you're listening, we got the hint. We're going to stop talking about Billings after this video.
Hey everyone, welcome back to Chipstock Investor. Today we're going to be talking about Palo Alto Networks. And we were not originally going to be doing a video on this cybersecurity company after earnings, but there's enough interesting stuff going on at Palo Alto Networks that gives us a good indication on where the cybersecurity industry is headed in general. So we thought we would catch our viewers up to speed on what we think is going on and what the future holds for the cybersecurity industry.
Right. This chart we've shared multiple times in recent months. Check out our cybersecurity industry flow video and manual. A few weeks ago, we did an update on Fortinet where we shared this. And cybersecurity is a secular growth trend. We talk a bit in there how it's beginning to overlap and intersect with a lot of other areas of IT as well. We'll get into that here momentarily. The big takeaway here, huge growth potential. This is an industry now worth several $100 billion per year in global annual spend, expected to grow at about a 12% CAGR over the next 5 years, let's say. And it has, as a result, attracted a massive number of small point product providers and startups. And a lot of those businesses are an absolute mess. The industry is moving towards it's called a platformization approach, where you can get multiple products and services from one single company. One of those is, of course, Palo Alto Networks. And in their last earnings report, they talked about they were going to use their market leadership to consolidate the industry. That, paired with the fact that a lot of these smaller upstarts are, in fact, in a financial mess, has set off something of a consolidation race in the industry.
We've talked about this private equity firm a number of times in the cybersecurity industry videos. Thoma Bravo strikes again here with acquiring cybersecurity company Darktrace, which is based out of the UK. And then they also don't only purchase companies, they also sell companies. Here's one from Thoma Bravo being sold to CyberArk. CyberArk is going to be acquiring the identity management leader Venafi. Here's another headline from Thoma Bravo. They have already purchased Logarithm and they have owned it for a number of years now, but Logarithm is merging with the company Exabeam, which is another cybersecurity company that delivers AI-driven security operations.
This is to self-quote and make fun of myself a bit. Mind-boggling. Thoma Bravo keeps showing up in these headlines. Those are just in the last few weeks alone. Here's one that doesn't involve Thoma Bravo, Akamai, which is an old content delivery network, old internet infrastructure provider, and a serial acquirer, making another cybersecurity startup acquisition, an API security company called No Name. I think we're going to circle back to this topic before too long and flesh out the IT sector flow. And we'll talk about content delivery networks like Akamai and Cloudflare. So more on that a little bit later on, just for a little preview. You can also sign up for our Discord channel access, either here on YouTube or on our Ko-fi shop for just $5 a month. We'll be talking about this company in Cloudflare over there before the video comes out.
That access is only $5 a month. That is less than your regular trip to your local coffee shop or your lunch during the week. And we provide a lot more benefit, I promise.
I second that, but we're biased. Okay, last one here, because there's more consolidation happening. And of course, Palo Alto Networks, the pure play cybersecurity leader, also making a move. It just announced about a week ago that it is acquiring IBM's security service called QRadar. This is an interesting one because there's actually a tie-up between these two businesses taking place. So Palo Alto Networks takes over QRadar and adds it to its Cortex software security service. But IBM is still going to be part of this. Essentially, the IBM sales and service and consultant team are going to essentially act as an extension of Palo Alto Networks Cortex service. So we've never addressed this in a video, but have written about it over the last couple of years. IBM has transformed itself in recent years into a cloud software and consultancy firm. And so this could be an interesting win for these two businesses. Palo Alto Networks, of course, consolidating more of the industry to itself for about $500,000, and IBM getting some higher profit margin cloud software and consulting fees along the way. Interesting one to keep an eye on here. And maybe this is where we should again plug our cybersecurity industry video and manual. You can find the link to that here. And then the video that we did a few weeks ago on Fortinet, which is the other cybersecurity pure play leader, along with Palo Alto Networks. But Fortinet, a very different business model. Rather than making acquisitions like Palo Alto Networks tends to do, Fortinet much more an organic growth and organic development cybersecurity play. Okay, lots of consolidation set off in the cybersecurity industry. Let's talk about that cyber industry flow. So you put this chart together a couple months ago. Where does Palo Alto Networks historically fall into the greater industry ecosystem?
Historically, Palo Alto Networks fits over there in the left side of the chart, the physical location, which could be the office, the factory, store, anything like that, where cybersecurity is needed to protect that physical location. But what we can see is that Palo Alto Networks is expanding beyond that, as we'll discuss a little bit further.
Yeah, that's right. As data centers and cloud computing have fragmented the IT sector and the general flow of data, Palo Alto Networks has made this pivot to next gen security services, many of those software based versus actual physical location and hardware based, like in the past. Even their traditional network security kind of going the software and service route. And then under CEO Nikesh Arora, who took over 7 years ago now, they made like a baker's dozen worth of cloud security acquisitions, as well as bolted on a lot of security operations software services that help companies monitor and orchestrate and manage their security and IT part of their business. So, what exactly is platformization? You can almost think of this as like an end to end security platform that covers everything. Large organizations have very, very complex footprints. They have physical locations and offices. They may have private data centers. They may also have a mobile workforce that can access data and applications while they're on the road, while they're traveling or from home. And so Palo Alto Networks converging a lot of these software services with the traditional network security business, and then going out and having these conversations with customers and saying, hey, are you tired of dealing with a myriad of different software cybersecurity providers? We can provide all of it for you all in one place. What do you think? Let's talk about that. So this kind of set off a bunch of questions and criticism about Palo Alto's new go-to-market strategy 3 months ago. How did they do 3 months into this new plan? What were the results?
We'll talk about the Q3 results for Palo Alto Networks. That was the 3 months ending in April. Their total revenue came in at just under $2 billion, which was 15% year over year. One metric that we have traditionally focused on a lot, and the market has certainly focused on, is their billings number. And their billings came in at $2.33 billion, which was up 3% year over year. Their revenue came in at the top end of their guidance. They planned for 15% year over year, and they hit that goal. And the billings came in at the midpoint at 3% year over year. Earnings per share beat their expectations at $1.32. Their high end of guidance was $1.26.
Now, Casey, before we discuss the billings issue a little bit more, let's maybe point this out. This was Palo Alto's expectation for Q3, stated 3 months ago. And maybe I'll direct everyone's attention to the bottom highlighted section there, where they had called for full year fiscal 2024 revenue. That's for the 12 months that will end in July 2024. They had called for 15 to 16% growth, upper end of guidance, $8 billion. Pretty solid growth rate for a very, very large business. And they slightly raised that full year revenue guidance, now solidly expecting 16% year over year growth for fiscal 2024. This is pretty good, I would say, especially for a period where everyone on Wall Street is looking at cost cuts. Everyone in the corporate world is looking at ways to save money. No one's really in growth mode right at the moment, with the exception of the AI super cycle that we're in. So Palo Alto Networks definitely still riding this secular growth trend in cybersecurity, despite what is still a bit of a soft patch for software and for traditional IT. But let's maybe get back to the billings conversation, because 3% year over year growth for billings is an indicator that Palo Alto Networks is headed for a significant slowdown in revenue expansion, right, Casey?
Just as a reminder, what billings are exactly, that's a future commitment to spend on the product or service. The customer has been invoiced, but the payment has not yet been received. We're talking about something that's happening right now or in the next quarter.
So maybe we should just rewind here 3 months. This is Nikesh Arora on the last earnings call back in February, where there were a lot of questions coming up about this platformization approach. It must mean that growth is petering out if Palo Alto Networks is suddenly saying, hey, we're going to get really aggressive in giving away product for free. And Aurora basically said, no, we're not exactly giving product away for free. We're just going to try to consolidate the market. I think going back to the beginning of this conversation, there's lots of consolidation happening in the industry right now. Private equity firms like Thoma Bravo getting involved. And it's not because there's a lack of future potential. On the contrary, there's still plenty of future growth potential for cybersecurity. It's just that a lot of these smaller businesses are broken. And so Palo Alto Networks see an opportunity here to consolidate some of those broken products to themselves. That's what platformization is referring to. And now let's fast forward again back to this last earnings call on May 20th. Aurora says no changes in trajectory. Most customers are still looking to consolidate the number of vendors that they use for security and other related IT operations projects.
I feel like this makes a ton of sense. When we talked about Palo Alto Networks strategy before, we talked a little bit about human psychology. If we as an individual want to consolidate all of our services, how much more so would a multi-billion-dollar business? This was a nice comment that Aurora mentioned. He said that if they were measuring their progress by meetings, they have gone up 30%. And the vast majority of those meetings with businesses have been centered on platform opportunities. Businesses are having these conversations about consolidating.
Yeah, that's right. And that includes with the new IBM deal that they struck. This is more just platformization. IBM, not the biggest tech company involved in security, but still a significant player. And this is a way for Palo Alto Networks to extend the reach of those conversations with customers. IBM making that pivot to a cloud and software consultant in many ways. So they're also having lots of conversations with companies on how to manage their operations in this new data center, cloud industry, AI. And so IBM added to the mix. And at least as far as Palo Alto Networks CFO is concerned, this deal still fits within Palo Alto Networks' long-term framework for profit margin growth. We'll circle back to this here in a moment, but let's maybe come back to the billings again, because this has become a very, very messy metric from one quarter to the next because of these platformization conversations. So 3% year over year growth in billings for Q3 fiscal 2024, but then the outlook for Q4, it looks like we're going to get a really quick snapback in billings growth.
Yeah, absolutely. It's up to 9 to 10% year over year. And they expect the full year 2024 to come in at 10 to 11% year over year.
Now, Casey, you pointed out billings tend to be a short-term growth metric. This is significant as Palo Alto Networks has matured and they have this very, very broad ecosystem of products and services on offer. They're now able to offer one customer, multiple services all in one package. What they've been doing is they've been striking more multi-year deals. And a multi-year deal does not flow through into billings, right?
Yeah, this is an interesting point. This helps us see this picture a little more clearly. Billings are a very immediate metric, but all those multi-year deals that they're making are actually going to come in as deferred revenue.
Yeah, that's exactly correct. And so deferred revenue is a different metric that shows up on the balance sheet. We won't discuss that in depth here, but starting with the fourth quarter of fiscal 2024, and especially as we head into fiscal 2025, we personally are going to take the hint from Palo Alto Networks management team and stop focusing on billings. And instead, we're going to start using deferred revenue on the balance sheet as more of the guide for Palo Alto Networks' long-term growth trajectory. Mr. Aurora and team, if you're listening, we got the hint. We're going to stop talking about billings after this video. You've been hinting that you might be doing the same. So that's kind of our expectation from you, if you're out there listening. And I suspect someone from your team is.
We heard you loud and clear. Okay, let's talk about some more expectations in the next couple of years. Since 2021, Palo Alto Networks has been making steady revenue growth, steady free cash flow growth. However, their net income is projected to take a bit of a hit. Why is that, Nick?
There's a lot of factors involved here. A lot of it has to do with the easy one to call out because everyone became hyper aware of employee stock-based compensation during the bear market. That's going to be one reason GAAP net income is a bit more volatile than free cash flow. However, it's not just stock-based comp, it's also depreciation and amortization expense. Remember, Palo Alto Networks has made quite a few, some of them very sizable acquisitions. And now this latest one, 500 million for IBM's QRadar business, that all gets amortized over time. So the money is paid and that actually hits free cash flow and it gets measured in that quarter that the expense takes place. For GAAP net income, the acquisition is amortized over time. The expense is not realized right now in that quarter. It's broken up into chunks, and that expense realized in each subsequent quarter, in each subsequent year over some period of time. So that's why GAAP net income is still highly volatile for Palo Alto Networks. As the business continues to mature over the coming years, though, these two metrics will continue to converge on each other. They'll continue to get closer, free cash flow and GAAP net income on an annual basis.
If you've been following us for a while, you may know that sometimes we use a blend of several different metrics to come up with the valuation. And Palo Alto Network is a really good candidate for using a blend of GAAP earnings per share and free cash flow earnings per share. The company has grown up enough that the earnings per share are definitely a key metric that we look at, as well as free cash flow. So Nick, why don't you walk us through this reverse DCF? This is an update from our last video. The current stock price is around $312, market cap of $101 billion.
Yeah, and that puts Palo Alto Networks at about 45 times trailing 12-month earnings per share and only just over 30 times trailing 12-month free cash flow. So there's a pretty big discrepancy between the two. So what we've done, we have this belief that GAAP earnings and an adjusted GAAP metric, free cash flow per share, will converge over time. So we've just taken the two and averaged them out. So the average of earnings per share and free cash flow per share comes in at $7.72 over the last trailing 12-month period. So what gets us at a fair value today of $312 or that $101 billion market cap? Very, very simple reverse DCF that we plugged in, wherein if you expect a 22% growth rate in per share profit for the next 3 years, and then a 6% per share growth rate after that, and using a discount rate of 10%, that gets us to a fair value of about where the stock is priced today. So now the question for each of you as investors is to determine if this is a reasonable per share profit growth rate for Palo Alto Networks. Is this a reasonable expectation over the course of the next 3+ years? If it is, if you think this is a hurdle Palo Alto Networks can clear, this stock might be worth nibbling on or adding to your portfolio. If not, pass and move on to something else.
Palo Alto Networks has been in our portfolio ever since Nikesh Arora took over as CEO. About 6 or 7 years we've had it in our portfolio. We have a full position. We're not planning on adding any more at this time. So we're just going to hold what we have, and we're happy to do that, especially after looking at some of these metrics.
Yeah, absolutely. I'm more than happy to continue holding. It's been a tremendous run under Aurora's leadership. And though controversial, there's early signs that this platformization approach, where they try to consolidate market share, is going to work. And really, they need to, because that's happening in the industry anyways. Like we mentioned before, Thoma Bravo in particular has been very busy in just recent weeks alone. Palo Alto Networks has the financial firepower to do exactly the same thing. And so we would fully expect that this continues for the rest of 2024.
If you're interested in having access to all of our video notes and published manuals and great conversation and exclusive content, make sure you check out our membership here on YouTube or over on our Ko-fi page. Same membership for just $5 a month. Gets you a ton of goodies.
Yeah, that's right. $5 a month. In most markets, we cost less than a hamburger Happy Meal. It's cheap, folks. Check it out.
We're going to keep this running with all sorts of comparisons here until you sign up. But if you just want to support us in a free and easy way, just hit that subscribe button. It really helps us out by just hitting that button. In addition, we have a live Q&A session coming up over on our Discord channel after NVIDIA earnings. So if you're a member, make sure you join us 8 a.m. Pacific, 11 a.m. Eastern in the US. And we will be back with another video, of course, after NVIDIA earnings as well. See you all soon at Chipstock Investor.